about yourself and your firm.
All right. Well, thanks for having me. I appreciate it. As we're all kind of locked down here virtually, it's great to get out and see so many people, even though they're only on camera. That's for sure. My career really has had three phases, and it's built to what I do today. The first phase, I came out of college and I became a real estate broker, and I sold commercial real estate. And while I was doing that, I was able to get on the CCIM faculty, where I stayed for 40 years teaching CCIM classes. And I learned a lot as a teacher. Boy, I'll tell you, you really learn when you're doing that. And after a certain period of time as a broker, I was out investing myself, and ran into a property that like almost all syndicators that I've interviewed, I didn't have enough money to buy it by myself, so I had to go out and find some investors, and that brought me into contact with the word syndication and securities, and actually went off to do a 15-year career in syndication, where I raised money from the broker-dealer network, basically, and built mini storage facilities. Primarily, I think we did 17 mini storage facilities here in Southern California. Built them, got them 50% occupied, and then sold them to operators of storage facilities. We sold a lot of projects to self-storage, or public storage, excuse me. And then one reason or another, the syndication business became something that I was really going to have to make a commitment to grow and grow bigger. My broker dealers wanted me to do bigger deals, which meant more staff, more space, more headaches. And my last year, I remember I counted, we sent out 1,676 K1s. Wow. We had over 850 investors, and boy, to do any more, I just didn't want to do it. So I went home to my wife and set her on the kitchen table where all the great decisions in life are made. And I said, what am I going to do in the next 15 years? Because I'm going to retire at 60. What am I going to do? And I had a stream of income coming, because I probably had 6, 7, 8 years of projects that I had done that needed to mature and all that. And so I said, I think I'll go to law school and be a securities lawyer. Well, that was 27 years ago. So I'm still doing that, and that's the only law I've ever practiced, and have a firm, and all we do is really, with the exception of 1 or 2 Regulation A plus offerings, we do Regulation D Rule 506 offerings exclusively. And we've done almost in this version of partnerships that I've been in since 2014, we've done almost 1,000 offerings. We're in the high 900s, and for about 700 unique sponsors. So wow. That's a big, that's much more than I thought I would ever do. And I'm grateful for it.
Yeah, that's great to hear. I would say certainly anyone who has already been active in syndication likely have heard of you, right, and have come across your name. And it's only someone everyone should know, right? Again, not just from structuring the deal to meet all the SEC requirements, but also just to knowing that someone is doing the legal work who actually has also done syndication himself. I cannot even imagine how you deal with 1,600 plus K1s and all the questions that you have to answer come from the recipients.
In those days, I was licking stamps and we were licking envelopes. There were today there are back office companies who would help me do that work. I would have signed up with one of the companies that my clients are using now, and someone else would have done that. But we didn't have that back then. If we had that, maybe I would not have left, although my life experiences in business have always gotten to a certain point, and to go to the next level up, I've always backed off.
Yeah. Yeah.
So, and you know, and right now my law firm has 6 people, and that's plenty big for me. Don't give me 10.
Yeah.
6 is just fine. You know?
Yeah. Okay. Very good. So considering that you have been in this world of syndication for longer than virtually anyone, including a lot of lawyers, I'm sure you have seen a lot of changes throughout that period. So maybe you can share with our listeners a little bit how the world of syndication and also the SEC rules have evolved over time.
Sure. Well, that's a good question. I think the number one thing that I've seen goes back, and it started really in 1981 when the SEC um, liberalized. They liberalized the ability to raise money by giving us more rules, actually. Because for a very long time, there was Regulation D, and there still is, and you could raise money, but you could really only raise money from accredited investors, and you couldn't advertise. And in 1981, they came along and they gave us Rule 506. And in Rule 506, what they did is they said, we're going to give you a definition of what accredited investor is as opposed to guessing. And we're going to tell you that you can raise an unlimited amount of money in a 506 offering from as many accredited investors as you want. And in addition, 35 sophisticated investors. We could never do sophisticated investors, but now we could. We still couldn't advertise, but the ability to take people who weren't accredited, and back then when they gave us the definition of accredited, $1 million net worth and $200,000 income, I mean, in 1981, $1 million was a lot of money.
Sure.
So that giving us the 35 investor limit of sophisticated investors who weren't accredited really exploded money raising. And that really allowed me to go into the broker dealer network where the securities reps had databases, Rolodexes of a lot of investors who weren't accredited, who were buying other things, but now they could invest in real estate offerings. That opened the market. And then comes 2012, the Jobs Act, where they said, okay, that set of rules is 506, that's fine. We're going to leave that set of rules and we're going to call it 506B. And then we're going to give you a new set of rules, which is 506C, which says now you can advertise. We're taking, the chains off of you. Go out and advertise and find all the accredited investors you want and sell to them. Well, although I wasn't selling syndications and I was already a lawyer, I saw the change, and I'll put it in my view. While I was syndicating, I could raise money from as many accredited investors as I could find, but I couldn't advertise. And accredited investors, if they found me, they could invest with me. Well, it was very difficult. Now with 506C, I can go out and I can find some of the 16 million households that are accredited investors any way I want to. And then they can go on the internet and through social media, they can find all the syndicators like me who are offering funds to accredited investors. And we really thought it would open everything up, guys. And I'll just tell you one more and then I'll get off of this rant. Every year, the SEC puts out statistics, and they get the statistics from the Form Ds that we file, and we file the Form Ds for all of our clients. And the last set of statistics, and it usually comes out in March or April. So I'm a year behind, but that's the most current thing. The private placement business is $1.8 trillion. That's 7 times the IPO business on Wall Street during the same period of time. $1.8 trillion is raised, and 99% of it is raised in Rule 506. But here's the surprise. 1.4 trillion of the 1.8 trillion is raised in 506B, where there's no advertising. Can you believe it?
Yeah.
And about 200 billion is raised in 506C. So it really never caught on. It never really caught on. And it's just amazing. Most of my clients have plenty of investors. They don't have to advertise for new investors, and they're doing social things where they're bringing new investors in the correct way into their database.
Right. Yeah. Yeah.
So that's amazing. Some of my newer clients will do a 506C just so they can advertise and build their database, so they can go back to 506B and do it. So that's amazing.
It's really very interesting statistic. So why do you think that is? Even if you have a very large investor database, right? And you say, look, I don't have to advertise because I have enough investors in my database to start with. Wouldn't that just help you to build in more of your database? So what is, have you talked to some of them why they still shift towards the 506B? I understand you have the 35 sophisticated that you can bring in, but is there such a big demand from the sophisticated investors that most deals are still easier done when you do a 506B?
I'll give you three reasons. Number one, referrals are not considered solicitation and advertising.
Right. Yeah.
So if you have a big enough network of investors and you're talking to them and you're doing good for them, they're going to present referrals to you. That's very good. Number two, a lot of the investors that you have in your database are accredited investors, and in 506B, all they have to do is check the box.
That's a good point.
Certification. Yeah. And to get them, if they've invested with you over and over and over just by checking the box, to get them to give up their tax returns to a third-party administrator to go through the third-party verification you need to do for a 506C, they're not going to do it. Plus, the third and the last thing is syndicators who have a strong track record are happy to know who their investors are and are a little concerned about taking people in the deal that they don't know. There's no question about that. My most prolific syndicator, I've done 121 offerings with them since 2014. They do 506B, only accredited investors. And 2 years ago, they froze their investment pool and their investor pool. Yeah. They don't take any new people at all.
Great and position to be in.
Yeah, all their offerings are maybe between $5 and $10 million. They're in the multifamily business, and they've got it. They've got a good program, and they're not gonna change.
Yeah,
that's amazing.
Yeah, very good. So just one more question, maybe John, you can jump in there too. Then, when it comes to that certification. If I'm correctly informed, and please correct me if I'm not, a third-party verification is not really required, but it's highly recommended from a sponsor perspective, so that you're truly protected. Right?
Well, the sponsor can do the verification themselves, if that's what you mean by someone needs the rule. The legal rules are the sponsor has taken steps to be reasonably assured, not guaranteed, reasonably assured that every investor is accredited. And they give you 4 or 5 steps that you can take. But most sponsors that I deal with don't want to ask John for his tax returns. And
Sure.
John doesn't have really a balance sheet that he publishes. And maybe maybe as a stockbroker, a CPA, or an attorney who will verify that he's accredited. But most sponsors sign up with one of the many companies that are out there
Right.
that you can Google and find who will do the verification for you. And it's not an easy deal. You have to be verified. Any verification you have of an investor that states he's accredited is only good for 90 days.
Right.
So
Yeah.
you have to continue to do that. So that's kind of a challenge. And I'll tell you something interesting. I do continuing education courses for CPAs on the securities world. And when I get to the point that we talk about we could send our investor to their CPA and their attorney and have the CPA or the attorney write a letter that they're accredited, I ask a polling question. If one of your clients came to you with this form letter asking you to sign that you know them and that they're accredited, would you do it? And then
Yeah.
I have a multiple choice. No. Only if it was a client I really knew. And then the other one was, gosh, I don't think I can do that, can I? And the answers are heavily weighted to no, I would never do that. And gee, I don't think that's in the provision of what a CPA does.
Mhm.
So that hasn't proven to be a very successful alternative for my sponsors. Most people typically end up going through a third
Party.
a
Yeah.
third party. And you asked the question, what's changing in, and one of the things I can talk about is what's changing right now. The SEC is continuing to do things that are going to open up, promote capital formation. That's what the Jobs Act was all about. They said, all the companies in the United States that have less than 500 employees are small businesses, and their path to money is through private placements. I mean, $1.8 trillion, but a very small portion of that is the real estate market. It's businesses who are growing and are raising money through Regulation D, Rule 506. And the SEC has come out with some rules that are finalized and are going to be effective now here on March 15th. So coming right up. I don't know when we're going to broadcast this, but they're either coming up or they'll be effective by the time
Yeah.
you broadcast this. The first thing that they're going to do is, which I think is a big deal, there's a rule called integration. And what integration is if you are doing two offerings and they're too similar or they're too close together, the SEC can come in and integrate them into one offering and apply the most restrictive rule. Okay, let's say you're doing 506B and you're taking 35 investors and you're buying dirt with 35 investors, and then you're going to do another offering to raise money to buy the building that's going to sit on top of the dirt, and you're going to get one investor that's sophisticated. Well, in the old days, before March 15th, if those two offerings were done within 6 months of each other, they're going to integrate them into one offering, and you get 36 investors, and you've blown your exception.
Right.
It's now a 30-day rule, just 30 days for integration. So you do an offering 30 days, and then you do another offering 30 days. You're out of the 6-month rule, which is amazing.
Sure.
And they're going to apply that to doing advertising. So if you do an advertising offering now, if I was succeed, you close that down. 30 days after you close that down, you could do a 506B, where the rule is today, you'd have to wait 6 months
Yeah.
after doing a C to do a B, because they're afraid that the people you're advertising to who aren't accredited are going to go into your new offering.
Right.
Well,
Yeah.
30 days, that helps capital formation. They're expanding Reg A Plus. We've done some Reg A Plus. We did Grant Cardone's Reg A offerings, and that was 50 million, and they're going to raise that to 75 million.
Okay.
And crowdfunding, which was always 1 million, which no one ever uses for real estate, is going up to 5 million.
Yeah.
Regulation crowdfunding, that might be attractive now.
Yeah.
And Rule 504, which typically no one uses, but they're increasing that to 10 million. And that's kind of interesting because 504 will let you go into 2 states that might allow advertising under their own internal securities laws. And so if you take your offering into California, which does allow advertising if you do it the right way, and California approves your offering, and then you take it into another state which allows advertising, you give them your offering, and if they approve your offering, now you can raise up to $10 million in those 2 states and advertise. Prior to that, we're talking blue sky here.
Right.
And
Yeah.
no one wants blue sky. In 506, it's preempted from blue sky. The states can't regulate you at all.
Right.
The federal government does. But now there's a possibility with being able to raise $10 million in a couple states. Maybe. We probably won't write any 504 offerings, but someone might. That's interesting. And then the last thing, for Reg A and regulation crowdfunding, and I'm looking at my list here, they've made the rules on testing the waters uniform, which means you can go out and you could put a billboard up and say, I'm going to bring out an offering that's going to be for hard money loans on real estate, and I'm going to pay 12%. Are you interested? And you don't even have your PPM written. You don't have anything.
Right.
You're just testing the waters to see if people are interested. You can't do that in 506, but you can do that in Reg A and regulation crowdfunding. So they keep moving the bar toward capital formation. But one thing is, and I don't know the name of it, but President Biden, since he's taken office, has signed an executive order which tells the banking and the SEC commissioners to stop what you're doing and look at stuff that's on the drawing boards and maybe you're getting comments on that hasn't been finalized, and look and see, is there anything you really don't want to do because it's not safe, or is there anything you've done recently you'd like to rescind? You know, investor protection is going to be big in this administration.
Sure. Definitely.
And the makeup of the SEC, the 5 commissioners, is going to change. So who knows? Yeah. I mean, they could come out tomorrow and decide that everything I just talked about, they're going to put on hold.
Yeah, it's a good point. Let's hope
we pay attention to that.
Yeah, let's hope it's not happening, right?
And so, you know, the next thing they're talking about is finders. You've probably heard they've got a deal out there getting public comments on can we employ finders. Employ isn't probably the right word, but can we use finders that we don't pay and don't do certain things to help introduce investors to us? Boy, that's just ripe with fraud possibilities.
Oh, definitely.
I hope they don't do that. That's terrible, but who knows?
Yeah, you never know, right? Coming back to that 506B and C, right, John? We work with a lot of syndicators, new and more experienced ones, and the interesting thing that we see is a lot of them, they started out with the 506Bs, and then they felt, well, let's try the 506C. And then they switch back to the 506B for the next offering, right? So
that's okay. And now, if they didn't wait 6 months, they're running afoul of the integration rule if anyone checks. Okay?
Right.
But it's not hard for the SEC to check because there's going to be a Reg D form filed on the 506 that starts February 10th, 11th, and then they're going to do another Form D for the 506B that starts March 3rd. It doesn't take much to put those together and see that there's trouble.
Yeah, definitely. So shortening that time frame would greatly help. Right.
Anton, one
Yeah.
question.
So, but I think the newer people, I'm having a little gardener noise. I hope that doesn't destroy everything, but they should be going. They're right outside my window here right now. I forgot exactly what I was going to say. So, my newer clients sometimes want to do a 506c even on a small offering. We have one on the street now where they're raising less than $1 million, and they're going to do 506c so they can broadcast it and get out in their social media and capture as many people as they can and bring them into their database.
That brings up a question.
Strategy.
Gene, question I'd have, you touched on something there with a newer client, someone that is doing maybe a smaller capital offering. My question would be, how do you think about engaging someone that's newer to syndication? Because we get a lot of folks that listen to our webinars.
Well, I'm really having trouble hearing John.
Yeah, can you speak up a little bit, John?
Yeah.
Sorry, any better?
Yes, thank you.
Sorry about that. Sorry, bad mic. But my question is, we get a lot of investors that are kind of getting started in the syndication space. How do you get them comfortable with something that's so complex? Because I think that, we've touched on a lot of very complicated, items and at a very maybe higher level, but, it's a very complicated space. What's your approach to getting folks comfortable, without having to walk through the whole process, but what are some things that, you get folks, a sense of comfort that, well, I will look after your best interest. This is something that you can do as far as getting out and raising capital.
Well, are you asking how do we make the passives comfortable, or how do we make the new syndicators comfortable?
The new syndicators, folks that are wanting to grow.
The new syndicator has put their foot in it. They found a property they want to buy and they don't have enough money. So you either walk away and don't do it, or you say, by God, I'm going to do it. And I've been doing a series of interviews. I think I'm up to 25, 26 interviews now with people in the business on our YouTube channel. And when I ask them, the last question I ask is, what advice do you have for rookies? And John, that's what you're talking about. And almost without exception, they say, have a team. Don't do this alone. Get together with people who have some experiences on different things, not necessarily syndication. Maybe the team is 3 people and we're all doing our first deal together, but at least there's comfort or misery and comfort, or whatever the way that saying is. And I think that's very important. I think that a syndicator needs to be educated in the asset type, so well educated that they feel comfortable in investing in it on their own. And if they had enough money, they'd buy the property that they're looking at themselves because they know it's a good deal. They just don't have enough money, so they go to investors. And I also think that your first syndication, if you do it right, isn't really about the property. Don't get so hung up on the spreadsheets and all this, because in your first deal, the investors are going to invest because of you, John. The investors don't know about the property either. They just know that you've been in the real estate business and you've done well in the real estate business. They don't have the time, the money, the knowledge to do it themselves. And, oh my God, John, are you really offering me an opportunity to invest with you? See, I think passive investors, and I say this a lot, you guys have probably heard this, passive investors call me and say, will you look at this deal? And I said, no, I won't. But these are the 4 questions you've got to ask. Ask the sponsor, John, if I give you my money, what happens if something happens to you? So you got to have continuity. Don't invest if there's just one manager. Number 2, John, have you done this before? And all of us have had to say no. But John, you've got experience in real estate, so tell me about your experience so I feel comfortable that you know what you're doing in the real estate space. Okay. And it's real important to get your first deal done. So when they ask you that question, John, you say, hell yes, I've done it once. Okay, that's fine. And then Are you going to have any skin in the game, John? Are you going to put some money in there with me? And not only am I going to put money in, you say, but I'm going to sign the mortgage. So I have more than just skin in the game. And don't forget to say that. If I'm a sponsor, don't forget to say I'm going to sign the mortgage. That's a big deal. And if you're a passive investor and you hear that, that should be good. And then the last question the passive should ask is, John, if something happens in my life, do we have any provisions for liquidity? And John, having been a good syndicator and reading the documents that attorney has given him, says yes. In Article 12 and 13 of the operating agreement, we talk about liquidity, whether it's forced on you or whether it's voluntary. And we have plans for both of those. And those are the 4 questions a passive should ask. Not what's the cash on cash, not what's the cap rate, not, you can talk about real estate. And in addition to that, I think the passive investor has an obligation to himself or herself to get educated in the asset class that they're going to invest in. There's plenty of guys out there who are teaching you how to invest in apartments, teaching you how to invest in mobile home parks, teaching you how to invest in storage facilities. Go take some of those courses. Learn about the product type, because the syndicator is not going to teach you about the product type. The syndicator is going to teach you about his deal, her deal. So you better have a broad knowledge of the product type so you know what questions to ask. John, does that make sense? Do you think that's something a passive should do?
Yeah, that's exactly what I was trying to get to. Is one, your encouragement of that you just have to step into it and find a good partner that knows the path that you need to follow, that can advise you well and be able to get through your first deal. And then and excellent points for passives about what they should be thinking about as they're beginning to look at deals. I could only imagine.
Well, I'm telling you that this business quickly, if you're an active syndicator, after you get past your second or third deal, you're in the people business. You're not so much in the real estate. You've got a team that's working on the real estate. The real estate may be 2,000 miles away from you, but the people are as far away from you as their keyboard. Sure. So, you're in the people business, right, Anton? Right?
Yeah, absolutely. Right. One question I have is when it comes to particularly passive reaction, and that will also how the sponsor should deal with it. And the reason I'm asking is we have seen it now more and more over the last year or two, where sponsors are raising money, right? So they plan to do the typical 506B or 506C, and then they realize, oh, we have a problem. We cannot raise all the money that we plan to raise. Now, everyone has been talking about private equity checks. Oh, why don't we bring in some private equity here? And now that is something that has come up more and more, where the sponsors say, well, we need to fill that capital stack and let's get a big private equity check. Now, certainly that private equity has a preferred position, gets 8 to 12% or whatever the percentage is. So how would you advise sponsors as well as the passives to react to this? Obviously, you initially drafted that PPM, assuming it's a standard 506B or C without having a pref position in front of them. So what do they need to do to protect themselves as a sponsor? But also, what would you advise to the passives who have originally signed up to essentially a different deal?
Well, let's look at the operating agreement. My operating agreement, and this deals with cash management. My operating agreement allows a kind of a cascade type of how do I bring in more money if I need more money. Number one, the operating agreement gives the manager the right to go to third parties to borrow money, and it gives the manager the right to negotiate that borrowing in whatever the manager, the sponsor thinks is in the best interest of the deal. Okay. Number two, it says the manager could make advances, short-term advances. And in my operating agreements, the terms of those short-term advances are spelled out so everyone knows how much interest the manager can charge and take and what are the terms. And then the third thing says the members could make loans. The members themselves who are already members could step in and make individual loans, and the manager can negotiate that with the members. And when all those things have happened, the cash distribution pattern changes. There won't be any distribution until the manager advance is paid back and the member loans are paid back. If it's a third-party loan, you treat it just like a second mortgage or a bridge loan. That's fine. There might not be any cash to distribute, but there wouldn't be a rule against distributing it. Then, of course, there's the infamous capital call, which never works. So my documents call that. The question is your entity formed yet? And generally, your entity gets formed when you raise the minimum and break impounds and accept investors into the deal. So if you haven't broken impounds, I think you have to redo your documents and you have to tell the investors, this is the new capital stack. Do you want your money back? Mm-hmm. If you've broken impounds and they've all been admitted into, and this would happen when you're trying to buy a property that's a value add. You have to raise $3 million to buy it and $1.5 million to do all the work and put the reserves to the lender. And that's what you're short on is the reserves and doing the work, but you've already closed the property. Well, then you have to look at what the operating agreement says.
Mm-hmm.
And,
yeah. So that's only the case, right? Once you closed on the property. What I was referring to more was obviously with mezz debt and all that, where you have actual debt. That's a little bit different. What I was more referring to, where essentially they create a separate class of equity, right?
Well, the operating agreement has to allow that.
Yeah.
So you wouldn't have to create a separate class if the operating agreement allows you to go out and borrow money from unrelated parties. You just go out and borrow it. And I don't care if it's an equity, if it's a shared equity loan. You give them X percent and then you give them part of the sales proceeds. And man has the right to do that as long as we've reached the minimum. If you haven't reached the minimum, then you don't have any members. So you have to go back and adjust your offering documents, because the whole key in the offering documents is total disclosure.
Right.
And if you're changing the deal, but you really don't have the permission to do that. Once again, a flat out statement. Yeah. If you haven't reached the minimum and formed your entity officially with members, you better modify your operating agreement to allow that, and then give everyone a chance to take their money back. But you formed the company and you put in there that you have the right to do that. Do it. I don't care. There are a lot of things that go on the street that I don't think are legal and run potentially in the area of fraud and misrepresentation. So I do think you have to be careful. But if you don't have that clause in your operating agreement and you decide you want to go out and get that private equity, I don't know how you could do that, because now you'd have to have all the investors vote on a change to the operating agreement. And usually the operating agreements I write say that if the manager wants to bring people in a superior position to the existing investors, you'd have to get a vote, maybe 75, 80 unanimous. You'd have to get a vote to do that if it's going to be a superior position. But if it's just a loan, it's not necessarily
it's different,
a superior position. Yeah. And that's too bad.
Yeah.
It's too bad that they have to do that. So.
Yeah. Well, but It is what it is, right? I think what you just highlighted is really key. Transparency is key, right? So that the investors, the passives, know what they are getting themselves into, doing the money raise, and that they clearly understand what they what the consequences are after the deal has closed, and what the sponsor can and cannot do, right?
And certainly today with financing and with the way the lenders want 12 months of all this stuff in reserve, I mean, you could come out with your offering before you finalize the loan.
Yeah.
And say, this is what I need. And all of a sudden you have to get an extra $2 million to put in reserves. Well, once again, my question would be, is your entity actually finalized? Is it formed?
Right.
And if you haven't broken impounds, it's not formed. I mean, you can always give the money back.
Sure.
Give the money back. The investor said this isn't going to work. And then you're out. The sponsor is out, hard money. The sponsor's taken a loss. The sponsor isn't going to get the income they thought. And all of a sudden the issue becomes, is the sponsor more concerned about the sponsor than the sponsor is concerned about going into a deal that isn't well funded and has a potential of losing money for the investors? And I see both sides of that question.
Yeah.
But there's really only one side. You got to protect the investors or you're out of business.
Absolutely. Yeah. It's a very good point. Before we wrap up, one other question I've had, and we have seen it now more and more over the last couple of years, I would say, where syndicators are willing to take on tech investors, right? Obviously, you live in California, right? And a lot of Californian investors, they want to invest outside of the state, sell their property in California, have a big chunk of money that they want to protect in a 1031, do not find their own opportunities, but have plenty of access to all these syndication deals. And there's only more and more syndicators that are open to accepting a tech structure. What have you seen there? What has worked well, and what has not worked that well?
Well, I'm a child of the TIC world in 2004 to 2008, 2010. I was active in that world, so I'm pretty comfortable with the pluses and minuses of a TIC structure, and I'm sure I do one every month. I do one every month. The most recent one we did, which I thought was a little complicated, is we had a syndicator who found an investor who had like $13 million in a family trust equity in a property owned by their family trust, and another $12 million in equity in a property owned by a corporation. And that was $25 million. And the deal needed 30 million. So my client put together an LLC to bring in the 6 million. And so we have 3 tenants in common.
Yeah.
And that can be done.
Yeah.
The problem, the real problem is decision making. Because no one has control of anyone else's deed. So in that case, it was okay because this husband and wife controlled the family trust and controlled the corporation. So we were looking at them, we were looking at one decision maker. And then my syndicator was a decision maker and an experienced real estate operator. But what if a difficult deal comes down the road and things go bad? And we need some major decisions made, and no one can control the other person. So it's a terrible way to run real estate. It's an absolutely terrible way to manage real estate, but it does accomplish, and it's the only way you can accomplish generally the deferral.
Right.
The deferral of the gain. And if you do it right, it's fine. Then you can go on to the next property. If you do it right under audit, it can all blow up for you. So I think we should all be watching what the government is going to do in the next 6 months about a tax reform and 1031.
Mhm.
I mean, we won't have this issue if they do away with 1031.
That's true, yeah. So I think
But
the
I,
general consensus today is that they will not take it away, but you never know, right?
yeah.
So,
The last time what they did is they took away the personal property part of it, which is
right,
huge because there are more 1031s done in corporate business property than there are in individual investors. You have a plant in Sheboygan and you need a bigger
sure.
plant in Des Moines and you exchange the whole thing. Well, all of a sudden, all the personal property doesn't qualify. And all that personal property has been depreciated to zero.
Yeah,
So if they get anything for it, it's ordinary income because they took more than straight line and so on. It's a can of worms, but that changed everything.
yeah,
So maybe who knows what it's going to be, but yes, that's fine. And I will tell you what I'm finding today that I don't like in the market. And I always take a risk when I tell this because I could be telling this to someone who does this. Okay.
yeah,
I don't like the idea that sponsors who are going to go into a value add property and know that there's no cash from the operations that can be distributed for the first 6, 8, 12 months. They raise extra money and then they send people that money because everyone likes to get a check
right.
without fully disclosing that that is a return of capital. It's not earnings. You didn't earn anything to distribute, but we're sending you a check because we said we'd give you a 6% preferred return. That is fraud. Okay.
Yeah. So
And people
it's
do that.
it's an extremely important point that you just raised, right? That you can return the money, right? But it needs to be clearly disclosed that it's
Right.
a return of capital. So essentially, you just raise more money so that you can come up with that fake picture of that you are able to pay a preferred return right out of the gate.
And I think if you explain that to people, all I'm doing is I'm asking you for more money than I really need just so I can turn around and give it back to you. They may have other uses for that. And I'm not totally sure the disclosure works. We don't write offerings with that
Yeah.
provision. I can't say I've lost any clients over there, but I'm pretty in tune with the sources and uses and how we do that. My real estate background, I know what's happening. So I'm very concerned that that's and it, that's one thing. And sometimes it's more subtle than that. Sometimes you raised money for capital improvements.
Sure.
And the 6% clock is ticking and the property only produces 4. So you reach in the capital improvement budget and send 6 back without explaining what you've done. And there's one that could be fraudulent. And number 2, when you need the capital improvement budget, the money isn't there. And the investor is going to say, why can't you replace the air conditioners? Well, we sent you money for a return. We didn't need that money. We can buy our own groceries. We needed new air conditioners to do the project. But my most prolific syndicator that I've talked to you about with 120 some deals, his distribution is a 12% distribution.
Yeah.
8% preferred and 4% early, and we're going to count 4% as a return of capital.
Okay.
Fully explained, but we don't call it a 12% cash on cash because it's not. It's a 12% distribution, which is legal, 8% preferred, and 4% return of.
Yeah, excellent point, right? So make sure when you talk of cash on cash return, what you really mean with it, right?
Right. And I learned that in teaching CCIM early on. I learned the difference between return on and return of, and that's very important. And I'm kind of on the pulpit when I get a chance to talk about that because I really preach. And there are gurus out there who preach all sorts of weird stuff. And I'll tell you, don't do that. Just don't do that. Well, everyone does it. Well, I don't. Good. What did mom and dad say? Just because everyone does it, that's probably doesn't make it right, you know?
Yeah, that's right. Yeah,
Well, this has been great. Thank you. Boy,
very good points. I really appreciate you sharing all your knowledge. And again, you dropped some great nuggets there, particularly at the end, right? I think everyone should be well aware of that, that you stay within the law, right? So that was truly great. Gene, usually we ask, what are your contact details? We don't really have to ask it for anyone who sees the screen, but we also have it on audio too. So maybe if you still can provide us with your contact details, that would be great.
Yeah, the easiest way to get me is Gene@TrowbridgeLawGroup.com. And if your question to me seems like it has some urgency, I'll just call you. Okay. And the one thing I would like to talk about is our YouTube channel, Trowbridge Law. Because like I said, I've done a lot of interviews with people. And this morning I interviewed Robert Helms and Frank Rolfe, who's the president of the 5th largest mobile home park owner group in the country and an operator of Mobile Home University. And we publish all those interviews. And there's a lot of wisdom, a lot of things that I've learned from them. And we put that on our YouTube channel, and you get a lot of information. Going back to what John says, how do you get comfortable? How do you get ready to do this? Well, you learn. You read everything you can, and you watch all the interviews like you guys do. I watch a lot of these podcasts, and I'm interviewed on a lot of them, and I always learn something. So that's good. Thank you for having me. I appreciate it.
Really appreciate it. Good that you just interviewed Robert Helms. We are also financing partners for the real estate guys, right? So they are great educators, as you are on the legal side, right? And again, that's a key piece to get comfortable, is really educate yourself through whatever sources you can. And certainly appreciate that you did exactly that today with us. And so we see you soon, right? We are at an event together at the end of February in Houston, so we look forward.
Yes, I'll be there. I'll be there. Say hi to me, okay?
Yeah, definitely.
Thank you, John. Thank you, John. Thank you, Anton.
Yeah,
thank you.
Thanks, Gene.
Bye.
Bye.